Good morning, folks. My name's Robert Coulter. I'm the General Manager of Partnerships here at the AFA. I'm delighted to be introducing today's webinar. It's titled How to Build and Implement Goals-Based Financial Strategies to Last a Lifetime, brought to you in partnership with Morningstar. So today from Morningstar, you'll hear about they've designed a goals-based investment approach for financial advisors that ensures all investment decisions made to implement the goals-based advice are determined by your client's goals and cash flow needs across all life stages. Today, you'll walk away from this session confident that despite your clients requiring different financial strategies in pre and post retirement, aligning a goals-based advice and investment framework maximises the probability of your clients achieving their goals, needs and aspirations. You'll also discover how a goals-based investment approach that is centred on behavioural science and designed to help real people persevere in the face of market uncertainty can be implemented through all life stages and better keep your clients on track to meet their goals in pre and post retirement. Today, you'll hear from Matt Wacher, who is the Chief Investment Officer for Morningstar. Matt joined Morningstar in January 2019. He's responsible for leading the Morningstar investments team here in Australia and developing Morningstar Investment Management's investment capabilities and thought leadership profile in the Asia Pacific region. Matt has over 26 years industry experience, spanning family office, global equity programs, derivative-based investment strategies, corporate superannuation, traditional and alternative assets, to index construction and development in countries like Australia, Japan, and the United Kingdom. So before I hand over to Matt, I just want to cover off a couple of pieces with regard to housekeeping. So today, this webinar will attract one CPD hour available, and we'll send those out to you within the next week. We will answer questions, or Matt has agreed to answer questions at the end of the presentation. So please use the Zoom Q&A feature, not the chat feature down below, as you can see in the diagram below. This is also being recorded and will be available on the AFA site as well. Matt, I am really looking forward to listening and watching today's webinar. We've had a really significant response. Thank you for putting this important information together to help our members. Over to you.
Thanks, Rob, and thanks to everyone for giving me the time to speak to you today. As Rob said, I think we'll leave questions to the end, and I hope that's okay. But I just wanted to let you know that if you do want to ask any unrelated questions related to the markets, but not specifically to this, I'm happy to try and give you an answer at the end as well. You don't need to stick to the script on this presentation. I'm happy to try and give you our views, how we're seeing things at the moment. But for now, the presentation, as Rob said, was really focused on goals-based investing. And I'm going to cover off some thoughts on how we build strategies for the accumulation phase at Morningstar Investment Management, and how we're thinking about building a tool to help advisors manage client portfolios and cash flows in retirement as well. That really should be useful for clients talking to their to advisors talking to their clients about the trade-offs involved in that stage of life. Throughout, I'll try and address some of the behavioural issues your clients may experience, and how we build our portfolios to address some of these issues. First, I need to just pause on the disclaimer here to make sure my compliance department are happy. And I'll really start to give you a high level here of how we are thinking, what we're talking about here in terms of goals-based investing as a starting point. So goals-based investing, it really involves a departure from a typical risk tolerance framework that's delivered through an SAA approach. The strategic asset allocation, it's developed really on a backwards-looking data. You know, it remains static most of the time, a strategic asset allocation, and that doesn't take into account the market conditions or starting valuations from someone investing in it. Under this traditional approach, volatility and losses are, you have to consider them that they're acceptable. There's if you think back to March, for example, SAAs weren't changing significantly at that time. They'd obviously been set at a period prior to that. Now, I understand that compliance needs for advisors are very important. Risk profiling your client and allocating them to a relevant portfolio on the efficient frontier. You can see that in the chart here. The efficient frontier and where different types of portfolios might sit on that. It doesn't necessarily have great connection with your client's needs and goals. The utility function that you see there on the investor's utility function you see there on the chart. So this has issues in the accumulation phase, which I'll talk you through in the first half of the presentation, but also the problems with the SAA approach are much more pronounced in the decumulation phase, the retirement phase of someone's life. And I'll discuss that more in the second half of the presentation that I'm going to give. But essentially, some of the points that some of the more theoretical points that I'll discuss later, essentially retirement, the only way to avoid sequencing risk issues in retirement is to really classify all retirees with a defensive asset allocation. They're down the bottom of that efficient frontier there. But there's a key trade-off there. If everyone's in a defensive asset allocation, this is not likely to be appropriate because of longevity risk. You don't want to outlive your assets and the ability to fund your retirement. So some of the thinking that we've done is really around different types of approaches for retirement. The key issues, unless your client has a substantial portfolio and can live off the distributions, which is obviously becoming much more difficult at the moment as dividends and bond yields are much lower than what they have been in the past. If you can't lift off the distributions, you're managing a portfolio in outflow, and this really requires a different approach to investment management. For me, I can't emphasize enough this point. It's really confirmed, thinking differently in retirement is really confirmed by the way that other portfolios, other institutional investors that run portfolios in outflow think about their investment approach. And I'm talking there about insurance companies, defined benefit funds. They're not dominated by efficient market theory. They're actually coming up with actuarial solutions to the way that they manage money. So for the retirement solution that I'll talk about a little bit later that we're developing, it's quite simple at face value. It's a bucketing approach where the buckets and investments in the buckets between them are really driven by our valuation-driven asset allocation approach, and they're linked back to the goals of your clients. So we'll get to that first. But first, we've got to make it to retirement. So what am I talking about when I'm talking about a goals-based approach? Really, your clients, advisors and their clients have lots of goals. Some of them they're going to need an investment to try and help them achieve that goal. Some of them they're not. But the goals that require an investment-focused approach, you could classify them on a necessity basis and a time horizon. So for example, shorter-term goals that are necessary should have a lower risk profile, and that can be, even funding your day-to-day needs in retirement, whatever that might be. Shorter term goals that, for as another example, that are aspirational, or just a desire, something that you'd like to do, that trip to Europe when we can go back over there again, they can be invested potentially more aggressively. If the goal isn't met, then you can just push out the time frame. So we can classify goals into different buckets. Now, then you want to allocate assets to meet these financial objectives, given the necessity and the time horizon. So investment problems change depending on the phase that a client is in, the phase of life that a client is in. In accumulation, one of the problems can be your volatility, but volatility is only an issue for your clients if they trade when they shouldn't. if they make a poor behavioural decision. It's really a behavioural problem. But pre-retirement, a big issue is drawdown. Sequencing risk is a key issue. Having the wrong exposure at the wrong time is more likely to occur with a traditional SAA approach. And we could think, as I said, back to March for that, for many examples there. Post-retirement, one of the key issues is cash flow and ensuring that you have cash flow available to fund your retirement for the duration of your life, longevity. So understanding what the true investment problem is for clients and the phase of life they're in, and how you can align investment solutions with their goals and manage behavioural risks is really what we're talking about today. Just to start with, this is a key behavioural obstacle that needs to be overcome with investors. And Dalbar have done a quantitative analysis of investor behaviour, and they've done a number of these, but the one that I have here is from Q4 2018. I suspect that there'll be one for Q1 and 2 2020 coming out sometime soon. But the effects of investor decisions to buy, sell, switch into and out of funds over the short-term and long-term timeframes really affects how an investor's ability to achieve their goals is going to play out. So in 2018, for example, over 2018, where Q4 was a very down market, in the final quarter there was a very big drawdown, investors lagged the S&P 500 in both rising and falling markets, according to this study. The average investor was a net withdrawer of funds in 2018, but they didn't time exits well, and they were underinvested during the recovery months. So the older sell low, buy high strategy was well in place. And you can see from the chart here that the S&P 500 over the year was down about 4.38%. The average investor down more than double that at close to 9.5%. So outcome-based investing and how we link the goals to the investment objectives is kind of what I'd like to talk through a little bit now. So we get that clients have goals, and achieving different goals will need different investment objectives. All the goals may have different timeframes, and we've just discussed that, but traveling or buying a house will most likely have a different time frame to retirement, unless you're obviously doing them both in retirement. So in your 20s, you might want to buy a house in 5 years. You can afford to take some risk at first, but very quickly you're going to, as you get closer to needing to having that deposit, and you're probably going to need stability. Your clients will need stability. Similarly, if the idea of balancing sequencing risk of a negative event close to retirement is the key, then you don't want to be impairing that lump sum. You want to make sure that you've got enough to live on throughout retirement. At the same time as that, there's a trade-off involved there. You may require different investment objectives for the longevity risk component and the sequencing risk component. So people have a range of goals and throughout their lives, and they require different objectives, different investment approaches to each of those, and growth, income, stability, being diversified. That's what I'm talking about in terms of investment objectives. And we've discussed the goals there. It's very, very important to make sure that we can link those in a goals-based approach. So to define outcome-based investing, I think is the next step in the process. Outcome-based portfolios, and we run a number of outcome-based portfolios across the risk spectrum, some very unconstrained, some slightly more constrained, but nonetheless focusing on what we believe are going to help investors achieve their goals. Our outcome-based portfolios can really assist with achieving a goal by limiting the variability, the volatility around success. So we're not talking about volatility around a benchmark or something like that. We're talking about the volatility around achieving the goal. The idea the idea is to really achieve a goal in a risk-focused way for us. Only taking risk when we think we're being rewarded for it. Doesn't mean we don't ever take risk, but we want to make sure we're going to be rewarded for the risk. So back in February, for example, we entered the crisis with a lot less risk than many others. And that wasn't because we thought there would be a global pandemic and half the global economy would be shut down, half or more. But because at the time we felt that investors weren't being compensated for the risks that they were taking. You know, valuations in the markets were very high, and the achievement of objectives, in our view, pandemic and other things aside, could have really been impaired and goals not achieved. You know, when we're looking back in February. So we had less risk on board than others. But didn't mean we had no risk. Our portfolios drew down somewhat, but we felt that, at least in the areas that we were invested in, that we were being adequately rewarded for the risks we were taking over the longer term. You know, so that actually turned around. By mid-March, we felt that the risk-reward dynamics had changed significantly enough for us to be actually starting to take much more risk in growth assets. Building portfolios with enough value in them to exceed their objectives over the long term by some margin. And subsequently, again, it's been a wild ride. As the US markets have rallied, we've pared back some of that risk again, especially in the US markets, where valuations have become very high again in parts of that market. Because we think actually we can build a portfolio of assets that have enough of a margin of safety in them to deliver the goals of clients, of the end investor, without actually having to, you know, risk buying very expensive stocks. Now, an SAA approach, a traditional kind of approach to this, doesn't have the risk-aware focus that we're embedding into our process. So let me give you an example of what I mean, and apologies if this is a slightly complicated example, but I think just by looking at the slides that follow here, the next couple of slides, it'll give you a good sense of what I'm talking about. So what we have here is some analysis that was done by our team. An individual, 30 years from retirement, you see down the x-axis, the horizontal axis, that's time to the start of their retirement. And then on the y-axis, you have the funding ratio, how much they need to fund the amount of their retirement from, you see it starting at about 30% there, up to 100%. Now, so what that means is if someone needs $1 million to fund their retirement, then that's 100%, the top of the line there. And they'd start with, at 30%, they'd start with 300,000. And in this example, we're saying that they're saving a percentage of their total pay every year. And they're investing in a static equity fixed income split. And we've done some modelling around this, you know, forward-looking modelling, Monte Carlo analysis, to give us 1,000 different paths of what could happen. And what's represented in this slide is the 20th to 80th percentile, so 60% of the range of outcomes that could occur, and the most probable 60% at that. Now, what you can see is there's a wide range of outcomes. You can achieve the goals almost after only 5 years of being 100% funded. At the same time, you get to a point out where you're potentially not going to be funded completely at all, out towards year zero there on the right-hand side of the chart. Now, this is a simulation. The next simulation that we did was using a more dynamically managed strategy that uses valuation to position the asset allocation, similar to what we do in our valuation-driven asset allocation approach to our outcome-based portfolios. This is really based around maximising the probability of meeting the desired goal. Now, what we see from this chart is that we've foregone the chance of meeting the goal very early in many cases. You know, so the chance of meeting the goal in that first 5 years, or the early in the piece, is been locked off, it's gone. But at the same time, we've significantly removed a lot of the negative outcomes that occur down the bottom of the screen, the bottom of the chart here, if you can see my screen. Those areas down the bottom right of the chart. And we've, in doing so, we've also significantly improved the chances of meeting the goal. Up here, you can see that there's not those big drop-offs anymore. When you overlay the charts, you can see really what I'm talking about here. We've narrowed the range of outcomes. We've taken out, you know, all the poor outcomes, and we've made sure that there's a much higher probability of meeting the goal. And when you look at it, what we see is that rather than potentially only being 86% funded on average in this example, it's much higher at 92%, but more importantly, with a much higher probability of actually achieving that. Plus, as I say, the advantage of this approach is that we've removed so many of the negative outcomes that are possible for clients. So this is a stylized representation of what I'm talking about. And being stylized, it's not always the way it'll pan out. Certainly our approach at times, we would be happy to take more risk, and we may be slightly more volatile than a traditional approach, but this is what we're aiming to achieve in our outcome-based investment portfolios. What we're trying to achieve is a more consistent return profile compared to the traditional SAA approach. We're happy to go, as I showed you in the previous charts, some of the gains, in good faith that we won't participate in the losses to the same extent as a traditional approach. I'm not saying that we won't have losses, but we on average, we should be doing much better in the down markets because of our approach. We know that clients typically experience loss aversion, and that's a key behavioural trait. And what I mean by that is that they place greater emphasis on losses and are much more likely to change their portfolio, or worse, if you imagine back to March, selling up when the market sold off significantly. That would have been a terrible thing for clients to do, given the speed of the recovery. So we want to make sure that our portfolios help embed the sense that they should stay the course. So changing a portfolio, or worse, selling up and going to cash in response to seeing losses, is something that we try to avoid. Ideally, if we can limit losses in our portfolios, then they're less likely to trigger that irrational behavioural response that sometimes clients have in down markets, meaning they're more likely to stay invested, giving them a much better chance of achieving their goals over time. So theoretically, that's what we're trying to achieve. On the diagram here, you can see that actually both the SAA approach, the traditional approach, and the real return outcome-based approach appear to deliver the same result over the long term. And that may well happen in practice. And we believe that markets are reasonably efficient over time. And so both strategies may actually get you to the right result, but doing it with less risk helps remove some of those behavioural biases. So one very big assumption of them achieving the same outcome is that an investor doesn't fall victim to the behavioural biases that would see them act irrationally in market extremes. So why is this important? Well, I'm going to talk to you a little bit about compounding and negative compounding here. It's a key outcome of our process. We don't set out to make sure that we have great upside or downside capture, but we really want to focus on being risk aware. So with extreme valuations, there's an increased risk of a sell-off in overvalued assets. And the valuation component of a drawdown can lead to permanent loss. And I'm going to use the example, if you think back to, because it's probably everyone knows it, but if you think back to the 99, 2000s and the dot-com bubble, well, a lot of companies went out of business there as the market drew down, but also that impairment of capital with a company like Microsoft at that time that was very overvalued at the time, and then it's taken 15, 16, 17 years for it to get back to the levels that it was at back in, levels of valuation that it was at back in those days. It's taken a very long time to recoup the losses that someone felt back in 2000. So that's what I mean by the valuation component of a drawdown can be lead to permanent loss. And people often forget about the power of negative compounding. Compounding is I'm going to say it's a beautiful thing on the upside. However, it's much more powerful on the downside. And if you consider various scenarios, if the market was to sell off by 20% tomorrow, you need to make 25% back in the examples you see here, just to be even. And if it falls by 50%, you need to make 100% back. So to put this in perspective, using the recent market volatility, from the high on the 19th of February, the S&P 500, the US S&P 500 fell 35.4% to the low on the 23rd of March. And when I did this calculation yesterday, August the 3rd, the S&P 500 had rallied back 49.2% from the low on the 23rd of March. And that meant that it was still down. So what I mean by that, for an investor that invested $100,000 at the high, they would have now only have $96,000. So they've still lost 4% of their money despite the bounce back in markets. It's because of that power of negative compounding. So avoiding losses matters because losing less means you require less to bounce back and you can get back to compounding much more quickly. So this is just an example of what I'm talking about using our growth real return fund, and many of our funds would exhibit the same, and SMAs would exhibit the same traits. But our growth real return fund versus peers, we've only captured 80% of the upside that our peers have generated when we look at the information that we have. So only 80%, but more importantly, we've only captured 61% of the downside. And then when you look at that over 10-year track record, we've actually outperformed by having that upside downside capture. We've achieved our objective, but we would say we've taken much less risk than others have taken on to achieve that. And that's the outcome of what I've been talking to you about so far. So to talk you through, just to summarize this section of the presentation, a dynamic risk-focused approach enables you to minimize, we believe, allows you to minimize downside capture and can drive outperformance over the long term, as I've just showed you. However, there's something to understand and appreciate that I'm sure you'll all be wanting to be aware of about this style of investing. To have a portfolio that performs in this way means that it by definition will need to vary significantly from the market and often what peers are doing as well. Being conservatively positioned in the later stages of a bull market means that you're definitely not going to capture all of the upside. But we think that's a risk worth bearing. Our funds, in late February and even in the strong market rebound that we've seen over the recent weeks, have lagged peers, have lagged the peer group. However, our risk-adjusted returns are superior, and we've performed over the long term, outperformed those peers as I showed you. It doesn't mean that we should always be conservatively positioned. We should take risk, and we do take risk when we feel we're being rewarded for it. And we did that as an example in March. The focus on drawdown and being conscious of valuation and risk aware really pays off over the cycle and the longer term. This is a very goal-centric approach, or we would say it's a very goal-centric approach to investing. The idea of trying to focus on achieving a goal in a risk-focused way and only taking risk when we're being rewarded for it in order to hit an objective, we would say is quite client-centric, really helping a client achieve their goals. So I'm going to pivot now and talk a little bit about some of our thoughts on retirement and how our outcome-based portfolios can be used within our outcome-based strategies can be used within the retirement phase of life. So let me start by trying to express the retirement challenge. I think it's reasonably easy to express. It's more difficult to manage. So it's about cash flow management. Now, I'm not necessarily talking income there. I'm talking cash flow. How can we make sure that you can meet all of your expenditure needs from the assets that you have when you retire? So easy to express. But let's frame up the problem. When we retire, we actually know the quantum of assets that we have at that particular point in time. We're going to have superannuation, we're going to potentially have pension entitlements, and even if they're going to kick in at a later stage, you're going to have other investments. You might have a share portfolio, home, that you can access, that you have these assets and they're a known quantity to some extent. But from these assets, they're going to need to meet a range of different spending requirements. And I've categorized them into 5 groups here, and just for ease at this point in time. We've used these 5 categories because these are spending requirements that are going to have different timeframes, the different levels of certainty or uncertainty. Some are needs, others are aspirations. As I said, the European holiday, maybe well, we can't go on it now, but one day when we can again, you can put off. You don't need to actually go on that holiday. It's a want. Now, the challenge is to help clients manage the interaction between their sources of cash flow to create a sustainable solution for them to fund their expenditure, or the expenditure side of the equation, and not outlive their money. Now, that's a much more difficult thing to do than articulating the challenge itself. So in some respects, the retirement challenge, as I said earlier, it can be reviewed as an insurance type problem, an asset liability matching problem. When we look at it through this lens, we can draw on some of the techniques used by insurance companies to meet their payout requirements, and we'll get into that in a moment. But before we do, I thought I'd try and articulate some of the behavioural issues that your clients may experience as part of this, and how the approach that I'm about to describe might be overcome as part of this thinking. So I'll step you through the advantage of thinking in terms of goals, or what I'm going to call buckets. Thinking in terms of buckets not only has several investment advantages, but it really plays nicely into behavioural finance. It can really help you to assist your clients keeping your clients on track. So there's a behavioural bias known as mental accounting bias, and Richard Thaler, a researcher, he recognised that households routinely organise and evaluate their finances using a cognitive system of what he called mental accounting to aid self-control. And he did this experiment called the $10 movie ticket experiment. So I'll talk you through it. Imagine that you've decided to see a movie and you have paid the admission of $10 per ticket. As you enter the theatre, you discover that you've lost the ticket. The seat was not marked and the ticket can't be recovered. Would you pay $10 for another ticket? And this was the question he posed. Only 46% of the respondents in this piece of research said they'd purchase another ticket. So he then moved on and he asked the same participants to respond to another hypothetical scenario. Imagine that you've decided to see a movie where admission is $10 per ticket. As you enter the theatre, you discover that you've lost a $10 note. Would you still pay $10 for would you still pay $10 for another movie ticket, or for a movie ticket? This time, 88% of the people in the survey said that they would pay for another ticket. So what's interesting about this case is that either way, you would have lost $10, obviously. However, our tendency to put money into mental buckets meant that in the first scenario, the moviegoer had already exhausted their movie ticket funds. Spending $20 on a movie ticket would have been outrageous to that person. On the other hand, the second scenario illustrated that, there's another bucket in people's minds, another mental bucket. And we'll call this the general spending bucket, which might be a much bigger bucket than the one for movie funds. In this case, the loss of $10 in the general spending bucket did nothing to deplete the resources of the movie funds bucket, and was, an acceptable amount to spend from the general spending bucket. The use of investment buckets with clearly defined purposes can really help reduce investor behaviour that results in poor interactions with their money. And that's some of the analysis that we've done in developing this solution. You'll note as we walk through our solution, as I walk through the solution, mental accounting bias can be used as a tool to help keep your clients on track. And they're some of the tools that we're trying to develop as part of this solution. So if we think in terms of the breaking retirement goal into buckets, we know the assets, as we said, consumption is, your time frame is continuous. You're going to need to keep spending on consumption needs to pay the bills, to put food on the table. The lifestyle, as we said, I've put it down as more medium term. It's got a different time frame to than consumption, but it's also not necessary to spend that money. Unknown is a key area of for this kind of approach. An unknown time frame. You're not going to know when the inheritance is going to be delivered, or when you're going to require health care or aged care in the retirement phase of your life. So we need to think that through very carefully, those unknown time frame spending requirements. So when we turn this into an asset liability problem, well, we know our assets at the starting point. Liabilities, some are known, some are unknown, some can be budgeted for, some can't. Others, the unknown ones, they're not only unknown in terms of timing, but also in terms of size. In the case of healthcare and aged care costs, these can become, in retirement, the largest source of drawdown. Retirement, I'm going to say, it ultimately involves a series of trade-offs. So, the trade-offs being sticking to your spending, the client sticking to their spending plan. If they want to spend more, are they happy to take on more risk to account for that longevity risk that they may face? So does their risk tolerance need to change? Investing in enough risk assets versus not enough, but versus managing kind of sequencing risk is a key trade-off that advisors need to be aware of with their clients. And so we're trying to build in the portfolio construction of the individual strategies, but also in the buckets that we put together, we're trying to assist advisors have those conversations about trade-offs with their clients. So this looks pretty simple, a bucketing solution. And this is effectively a very simplified way of how it works. If we think like an insurance company for a moment, we're managing a portfolio in outflow. We have a series of liabilities to pay over time. For short-term liabilities, an insurance company would be looking to lock in certainty, and they do this typically by investing in bonds. There are liabilities further out that are less certain, and in terms of timing and size for an insurance company. And for these, an insurance company will invest in long-term, much higher returning assets with the sole purpose of reducing their asset liability matching issues, the mismatch there. So how do we apply this for an individual? Well, the solution we're developing, the tool that we're developing, has three buckets. The cash bucket, the sequencing risk bucket, and the longevity risk bucket. And they each play a different role, and undoubtedly our marketing team will want to change the names of those buckets when we roll this out. But the cash bucket, it'll hold a number of years worth of cash, whether that be one, might only be 6 months. There'll be an agreed known cash flow, and we need to lock that in for a period of time to allow clients to maintain their consumption, their spending. And we'd say that this would be accessible held in an interest-bearing account, for example. The next bucket, the sequencing risk bucket, we'd probably use something along the lines of one of our moderate or conservative strategies in this bucket. The amount of assets in here will be driven by the expected cash flow needs of your clients into the future, and also taking into consideration where we think we need to start to fund for unknown expenses. So it's important that this bucket is conservatively invested with a focus on capital preservation. And the reason why is because, as I've said a number of times, in retirement, you're managing a portfolio in outflow. The cash bucket will need to be replenished so that the client can continue to spend and meet their spending needs, put food on the table. We want to avoid being in a situation where the cash bucket needs to be topped up, but there's losses in the middle bucket, because this bucket is really focused on minimising sequencing risk, that middle bucket. And then the long-term bucket is aimed at growing assets to really reduce the risk or longevity risk, really reduce the risk of outliving your assets. And we'd envisage that this bucket would have a high growth strategy attached to it, or even an all growth strategy, depending on what's in the other buckets. And that's the role, to fill the role here of generating long-term returns. So while the solution looks easy in its construct, the key issues here, the key complexities here are the rules around replenishing the buckets. When to take profits from the longevity risk bucket, when to top up the cash bucket, and all of the issues around that. And the engine to the tool that we're developing is really the drives those decisions in the process. So just to kind of wrap up this section of the presentation, we think that goals-based investing, lends itself very well to the retirement problem. As the solution that we're trying to develop, we're really trying to align to a goals-based advice process. We want to take into account cash flow management, trade-offs between goals, and the impact of not sticking to the plan, and give advisors the tools to be able to have those conversations with their clients. As I've said, the solution we're trying to develop takes advantage of that mental accounting bias, and we think that we can make it easy in that way for clients to understand. The underlying investment methodology really allows you to focus on a discussion between trade-offs, the probability of outliving savings and clients' spending desires in retirement. Importantly, really importantly, it allows for access to clients for unexpected cash flows, those that aged care or healthcare needs, the hip replacement or the knees. In my case, I run a lot, so they'll probably come earlier rather than later. But you get access to the funds in this solution, unlike some annuities or insurance-based products. And the Morningstar tool that we're developing will really apply our investment expertise to managing the medium and long-term buckets, where we think we can add significant value through our valuation-driven asset allocation approach that we use in our outcome-based portfolios. We think that there's going to be a lot of work goes into the developing the appropriate timing for replenishing between the buckets, and we provide we intend to provide a lot of probability analysis to use in the advice process to have those discussions with your clients. And we look forward to launching this product later or this tool to be used in conjunction with our outcome-based, our real return portfolios later this quarter or early next quarter. So before we dive into questions, I'll leave you with one quote from Ray Dalio, and I like it. It kind of sums things up. Don't worry about looking good, worry about achieving your goals. And that's something that we would grapple with on a daily basis at Morningstar Investment Management. So following this webinar, and we'll get to questions in a moment, we'll send you an email with more information on the benefits of our investment approach and manage accounts in particular, and how Morningstar, importantly, can help support your business above and beyond the investment approach that we utilise. And that when you get that email, if you'd like to hear more from our sales team, there's an option to leave your details in the email, and one of our team members who I've outlined on this slide will be in contact with you. But with that, I hope you found that enjoyable, and I hope there's lots of questions coming through. And I'll ask Rob to come back and pose some difficult questions to me, or hopefully I forget a few easy ones too. Thank you.
Not at all. Thank you so much, Matt, and thanks for taking such a comprehensive view of things. Yes, we have got a lot of questions, and I know you focused particularly. Well, what I got out of your presentation is the difference between a strategic asset allocation model and your objective-based investing. Outcome-based investing. So there's a question around here which says, how does the outcome-based approach reduce the downside of the SAA approach? I think I heard your answer, but I'm very keen to hear it again.
No, sure. So what we're doing is really focusing on valuations, making sure that we are positioning our portfolios in assets where there's enough of a margin of safety to not impair capital permanently, and to really focus on managing that downside risk. As I say, only taking risk when we think we're being rewarded for it. And I think that the difference between an SAA approach and that outcome-based approach is that you with an SAA, you need to be taking a certain level of risk at all times. So no matter what the valuations are in the market at that point in time. So I guess, as I said, we could end up with the same result, but we think that having that more risk-focused approach will potentially end up with the same result, but without having to take on as much risk at certain points in the market cycle as you would. Doesn't mean that we won't, at the bottom of the market, be wanting to take more risk. Certainly we would, and we potentially would have a higher growth profile than an SAA approach. But that's really where we want to make sure we're being rewarded for the risks we take.
In the presentation, and it goes back a few slides, but you compared, there was a comparison against the Growth Real Return Fund performing better. Are there peers on page 17 compared against that? Or do you go against market benchmarks?
So that's a peer comparison versus the average peer comparison. We can also look at it. It's a similar result if you look at a market, an SAA type, naive type benchmark. But what we've done there is really use the combination of the peers and that includes both SAA focused portfolios and other outcome-based investors as well. So
what happens if you were, question without notice, but
sure.
Comparing them against the market, say an ASX 200 or MSCI, do you do that?
Well, I guess the key thing there is that our portfolios are multi-asset portfolios, so they're going to have bonds and cash and other assets in there. They're not going to be a purely equity-based portfolio. But to give you an example, I think that if we've done some analysis. If we looked at March, for example, I think the just in isolation that 1 month, the ASX 200 was down 20+% in March, and our portfolios were down around 7%, or our growth, that growth real return fund that is down about 7%, which we felt was a good result.
Got another question here. Can you elaborate on how you would address sequencing risk and the longevity risk growth targets?
So what the targets would be, I'm going to take that to
yes.
me.
Yes, that's how I've interpreted it.
Yeah, so I think in it really will come down. I think this can be quite a personalised approach as well, and that's the aim of the tool that we're building, is that there can be some optionality for different client needs and wants. But we would expect that you'd have a CPI plus an inflation plus 1 to 2% type target in the middle bucket, the sequencing risk bucket, whereas you'd have a CPI plus 4.5 to 5 or even slightly higher target on the more longevity risk focused bucket. And I guess the time horizons of those strategies, the sequencing risk bucket would be more 3 to 7 years time horizon, whereas the longer term bucket would be more 7 to 10 years time horizon.
Thank you. A question around the advisor tool that you were showing, and I know you said that the marketing team will get to it with some better definitions, but in the absence of that, so what form will this advisor tool take from a client's perspective? So how do you envisage an advisor using it with a client, or what's the interaction?
Sure. So we have some wireframes developed, so I can speak from what it's actually going to look like. But effectively, there'll be an inputs page, and we would see that the client's goals and assets, etc., all of the relevant information would be either input at that point in time or taken from another piece of software, depending on obviously the relationship the client has with the advisor and the information the advisor already has. That would then give you a range. Obviously risk tolerance would come into that as well. It'd give you a range of outcomes for different kinds of portfolios and different portfolio weightings that need to go into each of those buckets, depending, cash flow would be cash flow, spending needs would be another input that would go into it. And then it'd give you, the tool would aim to give you a series of probabilities of actually being able to meet your spending goals, and also the probability of outliving your savings. And we'd expect that based on those outputs that the advisor can have a conversation of, if the client spending was so high that they were going to outlive their assets by some margin, then that can facilitate a conversation with the client. And effectively, we're trying to give the advisors tools to the information to be able to have those conversations about the trade-offs involved.
So is it a tool that you would sit across from a client and show them and demonstrate? Or?
Indeed, yes.
Yes, okay.
Yes, sorry. Yeah, so it'll be a web-based tool, and it is a web-based tool, and they'd be able to sit there with the client and give them a few different scenarios as well, okay. Have that iterative conversation with them.
Yeah, fabulous. Got another question here, and it's a pretty big question, but and it's, clearly licensees dictate licensee rules with regard to strategic asset allocation. So they may well have a very fixed view in this. And the question is, how would they go about influencing the governance and compliance teams to move to the type of thinking that you're talking about here today, outcome-based investing?
Yeah, so some of our portfolios have, excuse me, sorry, I was so some of our portfolios are very unconstrained, but for the most part, they have each of the real return SMAs and funds that we run. They're outcome-based portfolios, but they still have some tie to a risk tolerance. So our growth real return fund, while it can invest in quite wide ranges, is still aiming to have a CPI plus 3.5 outcome, and with certain risk limits within it. And so it's not completely untied from what we'd consider a traditional approach, but it certainly is able to take. It doesn't have a strategic asset allocation and can take much greater deviations from any kind of traditional benchmark than you'd see. And we think that that's important, as I said, for making sure that we can be managing risk in a most appropriate way.
Thank you. You've talked, Matt, quite comprehensively today around bucketing and the style and the approach that takes. Will a bucketing style approach give you a better investment outcome than a standalone strategy? I mean, I know but could you elaborate on that? Would it give you a better outcome?
So what it's really aimed to do is, I think it's not aimed to give you a better investment outcome than going into a single strategy. I think that it allows a lot more personalisation for the end client. And that's kind of key, especially as managing those trade-offs that we discussed. But importantly, it's also aimed at helping with lots of those behavioural decisions too, around helping. It's aimed to help keep clients on track to be able to make sure that the advisor can have conversations with the client about, how much do we need in that long-term bucket so that you don't outlive the assets? How can we make sure that, we're spending an appropriate amount given how much we got in the sequencing, the middle bucket there. It's really about managing behavioural issues as opposed to coming up with a much improved investment solution as such. I think that, if you put it all in a wrapper around and just had it in one fund or SMA or something along those lines, then, you'd probably get a similar outcome for the risk tolerance of the client.
Couple more before we
Sure.
close, Matt.
Sure.
Does a risk-focused approach? So I know you spoke about that you like to take risk where it's absolutely appropriate. So does a risk-focused approach mean you'll never outperform in a strong market environment?
No, not at all. I think that in a strong, what I spoke about during the presentation was what we've seen kind of in late February, for example, pre the crisis, and currently in some US assets is that we think that they're, I wouldn't say they're in a bubble, but they're getting to very expensive valuations, and so we'd want to avoid those assets, and I guess we're happy to avoid those assets in the knowledge that they could fall quite heavily from a valuation perspective at some stage. Not saying that those companies are not quality companies, but they do have high valuations on them. And so where we would see ourselves outperforming is when we've taken a reasonable margin of safety in the assets that we're investing in, and that they don't have to, they're not priced for perfection like some other assets, and they don't have to, things don't necessarily have to change too much for them to actually deliver significant returns. And I'd say that some of the areas that we're looking at are currently like the UK as a region or as a country, or emerging markets. There's lots of pockets in emerging markets where there's some very interesting opportunities relative to the valuations that you're getting in the US, for example.
Thank you. And last question here. I'll just read it directly out. Some companies are moving from guaranteed cash to cash only. I'm not particularly sure what that means. What are your thoughts? Read that.
So perhaps they're talking about investment objectives. I'm not sure specifically what they're talking about there. But I think that cash, I think guaranteeing a level of cash is very difficult to do in this investment environment. I think, even yesterday with the, or today in the papers, sorry, with the RBA decision coming out later today, they're talking about, at some stage potentially getting down to 10 basis points for cash. So I think that perhaps that's what the question's focused on. Not wanting to guarantee any level of cash rates at the moment for end clients. I think it's a very difficult thing to do.
Yes. Matt, firstly, can I thank you for preparing such a comprehensive presentation today. I think lots of people talk about goals-based advice. I frankly loved how you've brought it alive today and how relevant it can be, particularly resonated with me. I mean, everybody's heard of the bucketing approach, and I think that does resonate with people, but building a tool that you can actually sit across from clients and make it come alive for them, and frankly defray the downside of humans engaging and getting out of the market at the wrong time, etc., etc., is to be commended. So well done to you and to the Morningstar team. This presentation will be available online on the AFA site. Of course, you can always get that presentation from the team at Morningstar. You've taken us through a really broad, category of topics. I think the risk time return piece, again, it really resonated with me. I liked your answer about that you'll only take risk when you're rewarded, and it doesn't give you the downside, and your focus on not having that downside. Again, I'd like to thank you for your time today. I'd like to thank the Morningstar team for putting this important webinar together. I'd like to thank the folks who tuned in and for all your questions as well. Thank you for making the time. Well done, Matt, Morningstar, and I wish everybody a very good morning. Good morning.
Thank you.